If you run a small business that relies on costly equipment or machinery to operate, then you may be interested in exploring equipment financing as an affordable way to make such a big purchase. I'm Corinne, a small business expert at NerdWallet, and today I'm going to explain how equipment financing works and where you can go to get an equipment loan. First, the basics. Equipment financing is a loan, typically a term loan, used specifically to purchase equipment, machinery, or hardware for your business. You repay the loan with interest over an agreed-upon repayment period, typically somewhere between 2 and 7 years, depending on the lender. And once you pay off the loan, you own the equipment. One thing that sets an equipment loan apart from other term loans is the fact that the equipment or machinery you're purchasing serves as collateral on the loan. That means you often don't need to put up physical collateral of your own, though you may still be required to sign a personal guarantee and/or agree to the lender filing a lien on your business. These are measures the lender takes to ensure they get paid in full, even if you default on your loan. Lenders may finance up to 100% of the total cost of the equipment, though some offer up to 125%. The additional 25% can be used to cover what are considered soft costs, so those are things that are necessary to set up and begin using the equipment, like the cost of delivery and installation. Now, where can you go to get an equipment loan? Well, generally you have a few options, each with its own benefits and drawbacks, which I'll cover. Online lenders typically have the most flexible qualifications of your three main lender options. Some online lenders accept borrowers with bad credit and startup business owners, and many of these lenders have simple online forms that allow for faster application reviews, loan processing, and funding. The downside to online lenders is that their interest rates tend to be higher and their repayment terms shorter than those offered by banks, credit unions, and SBA lenders. Banks and credit unions are likely to offer you the most favorable rates and terms on an equipment loan. In fact, a bank or credit union that you already have an account with is a great place to start your equipment financing search. However, it's important to note that these more traditional lenders also tend to have the strictest qualification requirements. You'll likely need a high personal credit score, at least a few years in business, and really strong financials to qualify. Finally, if you strike out with an equipment loan from a bank, but you have a personal credit score of 650 or higher, at least 2 years of business history, and strong annual revenue, consider turning to an SBA lender. SBA lenders can offer up to 10-year terms with reasonable interest rates on equipment loans. Just be prepared for a rigorous application process involving a lot of paperwork. For more information on equipment loans or to apply for one through our loan marketplace, visit nerdwallet.com. And if you found this video helpful, hit like and subscribe.